All right. Welcome everyone to our webinar on regulating innovation and what does it take. This is a special edition that will focus on the practical guidance for visionaries, leaders, and decision makers. My name is Ivo Jeník. I'm a senior financial sector specialist at CGAP, and today I am joined by my colleagues Denise and Mehmet. In the next hour or so, our plan is to talk about a few things all related to the question of what does it take to promote, enable innovation that helps to advance financial inclusion through regulatory and policy interventions, if you will. And we're going to take it from kind of broader, big picture perspective, then focusing on our concept of vision-guided regulation, and then taking a closer look on individual elements that this vision-guided regulation concept stands on. And so hopefully by the time of by the end of this presentation, you have a good sense of what vision-guided regulation is and how to implement it in your own roles and jurisdictions. We should have some time also for the questions and discussion. I would encourage, however, everyone to use the chat function and submit their questions and comments as we go through the presentation. I think it's very important for us because we can then also respond immediately to your questions or to your prompts or to your commentary. So feel free to do that. Also feel free to just use the chat function to introduce yourself, if you will. All right, so let's start with setting the scene and talking about the big picture. We are living in the world where one could argue that the financial system as we know it is not really working because it's leaving out 1.3 billion adults. And that's a really sizable portion of the adult population. Not only it's leaving 1.3 billion adults outside of the system, but many more people are currently underserved or served with the financial services that don't really suit them. And it's not only individuals who are currently excluded or underserved. There are also estimated 300 million informal micro and small businesses in emerging markets, many of which would face in aggregate the staggering $2.5 trillion financing gap. So these are really big numbers and a large problem that we are trying to solve. But those numbers are smaller than they were about a decade ago. And if we look at those trend lines coming from the World Bank Findex data, mapping out financial inclusion progress over years, and if we extend those trend lines in the future, we could easily conclude that by the end of the decade, we would achieve almost universal financial access. There's a problem, however, with this, and it has multiple elements. The first one, that financial inclusion defined as an access to accounts is not really the financial inclusion we are talking about. We want people not only have to access to financial services, but use those financial services on a regular basis and use them to their own benefit. So these are those other important elements of financial inclusion the way we define it. Access is one of them, usage is another one, but also positive customer outcomes in terms of better resilience, better capacity to seize economic opportunities, improved lives. And so that's one important problem with these trend lines. The other one is that it's going to be much harder to include those remaining 1.3 billion adults because many of them live in remote areas, fragile countries, they live under poverty line, and so it may be much more difficult to bring them into the formal financial service than it was with the previous billion. And financial innovation will undoubtedly play a critical role in achieving that objective. It will play that role as it has played that role in the previous instances. When we look at the last 4 or so decades, innovation has been absolutely critical in advancing financial inclusion. It starts all with the microfinance innovation on its own that helped for the first time recognize low-income customers as a viable segment worth serving. That then translated into another innovation called branchless or agent banking, where there's been a recognition and evidence that financial services can be distributed without dependence on the traditional brick and mortar system of distribution, and then naturally and then transform into the next wave of innovation, the innovation of mobile money and e-money, and the use of phone as the interface and key device for financial service distribution. Now, when these three different waves or eras or whatever we call it, we can point out one specific innovation that's been critical for advancing financial inclusion. We are living in a quite different world today, where there's a lot of innovations happening, a lot of technology of groundbreaking potential reaching the market. And so we are living in an era of many opportunities, where financial services are becoming modular, and more importantly, financial services are becoming a necessity to participate in economic, social, and other lives. And that has to do with what I would call hyper-digitization of our experiences. A lot of what we do and how we experience world is now happening through digital interface, and being active in the digital world really requires financial services and access to financial services as a proof of identity, but also as a means to transact, pass value, and so on. And so if in the previous decades financial inclusion was a secondary objective and something good to have, I would argue that it has become a policy imperative. And that's why we have been looking at how regulators can promote new wave of innovation that helps to advance financial inclusion. And so with the team partially represented here, but also consisting of other colleagues who are not here with us today, we have been asking this question of what does it take to enable innovation that helps to advance financial inclusion and other policy objectives. And we have interviewed hundreds of business leaders, leading regulators, startup founders, researchers, academics, and politicians and policymakers to get a sense of what that is. And we've covered really the whole world, in a sense, reviewed thousands of pages of documents, and what we're going to present today is a synthesis of what we found. A synthesis that we describe as a vision-guided regulation, a concept that is, in a sense, very simple and very intuitive, maybe to the point that it can be dismissed as too generic. But I would argue that the power of that concept is that it can be applied in different contexts, in countries big and small, rich and poor, advanced and advancing, because what we have really distilled here is effectively what we found in those very different environments. We have, as many of you know, published a report, and many of you actually contributed your knowledge to that report, for which I would like to thank you again. That report is a summary, and we want to build on that summary with more examples. I should say that we don't have time to go through all the details, and therefore the presentation we're giving today is a summarized version, but we will be posting on the event page the full version, which has more examples and more details on how to implement the vision-guided regulation. So what is vision-guided regulation? It's a concept that revolves around the vision, as you can imagine from or guess from the name. The vision at the center, but surrounded or standing on four critical pillars that we will explore in more detail in this webinar. The innovation, the tone at the top, the innovation culture, the industry engagement, and supportive mandate. So the rest of the presentation will be focused on those 5 key elements, and I will start with the vision and then pass the microphone to my colleagues Denise and Mehmet before bringing it to conclusion and Q&A session. So what is vision? In our definition, in our work, we have defined vision as a public sector pronouncement in different kind of forms. It could be just one sentence on the website. It can be a document, written strategy. It can be even a speech by high-level policymaker that defines the future desired state, in our case, of the financial sector. Could be also the country, the economy, the nation, right? So vision says in a relatively clear terms what it is that we want to achieve, and maybe even hints to the means by which we want to achieve that. Why does that matter? Something so obvious. it does matter because having that clearly well-articulated vision then serves as a compass and a criteria to prioritize activities and focus and resources. And I guess many of you would relate to the sentiment that today there are so many opportunities and so many risks that it's sometimes very hard to focus where it really matters. And that's where the innovation vision really helps. And we have seen that repeatedly in the countries we've studied, that where the vision exists, when regulators look at the whole portfolio of opportunities from decentralized finance to artificial intelligence and beyond, they are better able to tie those opportunities to their vision and say, well, this is what helps us really advance towards our vision. We have some examples here, but before getting to one specific example, I want to talk a little bit about the benefits. So there are external benefits and internal benefits of having a clearly articulated vision. The external benefit number one is that it does reduce the uncertainty that the industry faces. In many ways, it sends a very clear signal of what it is that the regulator is trying to achieve, and it creates predictability, and that is a very high value, as you know, in the financial sector. Being able to predict where the market is headed and what is regulated thinking is very critical. I already talked about the prioritization, but kind of switching to the other side of internal benefits. Besides the prioritization and budget allocation and decisions around hiring new skill set, for example, it does also empower staff to think about innovation in a different way. And we'll talk about innovation culture later, but it's very important that it helps to promote a different kind of mindset within regulatory authorities. And again, the leading authorities we have studied, they all do have this very strongly pronounced in how they think about innovation and how their innovation culture is promoted within the organization. Now, what is well-articulated vision? It's a vision that is ambitious yet realistic, right? So having an ambition to be a rich nation is not probably specific enough, and it may not be realistic if the time frame is, for example, too short. So the vision has to be informed by the context and should be, again, anchored in that context. It should be specific enough. Again, going back to the point, we want to be a rich nation is probably not specific enough, but being an international hub for a specific type of trade, for example, given the location of the nation and given the existing infrastructure, etc. These are some examples of what specificity may be required. But importantly, it is well understood. And you would be surprised, or we were surprised, to the degree to which people and stakeholders in markets where vision is well articulated did have that shared understanding what it was and how it was playing out in their specific field. And that comes with political support. Political really at the top level of the national government, where there is a clear understanding why the vision for the financial sector matters. Now, here are a few examples of what make visions less articulated, or what makes even well articulated visions to fail. One of them is ignoring a local context. Vision cannot be imported and cannot be copied and pasted. It has to have a very strong recognition of the idiosyncratic features and circumstances that exist in a given market. It can be overly complex. Associating vision with hundreds of pages of strategic documents is sometimes the misconception that leads to visions that are too complex, and it cannot be really too vague or high level, and I spoke about that before. Now, the other things that make it fail is obviously the weak communication or disruption in continuity or insufficient resources, something that I would like to highlight. Vision has to be backed by resources. And of course, countries have different resources and different levels of access to resources. So that comes back to what a feasible vision is. But the point here is that if there is a vision, there should be a signal that resources are allocated to the vision. Vision is not a social media post or statement that looks good, but has really nothing to do with the reality. So here's an example of country, in this case Brazil, and I'd like to welcome our Brazilian colleagues who are joining, many of them today from the Bank of Brazil and other institutions. Brazil has evolved, and we talk about this in great detail in the report, from the traditional conduct of business when regulators have their risk-based approach and just deal with issues as they come, to a more strategic perspective with the vision called BC Plus, announced officially in 2016, focusing on some key priorities, among them lowering credit costs, modernizing regulation, and increasing efficiency of the financial system. And that vision proved to be a really good compass, really good guiding principle, now amended to BC hashtag. That is basically a statement on the central bank website. On every single page that you go, you pretty much find this statement. And it's really good because the stakeholders also take it as a way of understanding where the market is going, what the regulator is thinking. And I wouldn't say that it's just because of the vision, obviously, but Brazil has been really successful in achieving this vision by implementing all sorts of groundbreaking initiatives, from the famous instant payment system PIX to open finance that really took off quite short after it was launched, to their regulatory sandbox and other pro-innovation initiatives. And so this is one example. We have many more in the full slide deck and also in the report. And with this, I'll pass the microphone to my colleague Denise, who will walk us to the next element, which is tone at the top.
Thank you, Ivo. Hello, everybody. Just confirming that you can hear me well.
We can hear you.
Thank you. Thank you. So the vision without people, it's not really effective, right? So this is the main topic of tone at the top. I cannot change the slides. Yes. Sorry. I can't change the slides. So tone at the top, we're really talking about the champions. This was really an element that we weren't planning to, in the beginning, to talk about people or champions, but really it was very clear on the countries that we studied that there was a champion. In all of them, we found this very clear personification of the vision in this champion. So we thought that this is really an element that should exist across all the countries that actually wants to promote innovation that is inclusive and aligned with the policy goals. So practically speaking, this is a highly high position decision maker. So it really needs to be high enough for this person to make a difference, because we often also find champions within lower level capacities too. But the types of transformations that we're trying to see, it really requires someone at the top to set the tone for the whole organization, the whole authority, so that it really encourages and empowers the staff below this person to also align with the vision and align their day-to-day lives, including their interactions with the market, with that vision. So it really empowers the whole organization. This person is a decision maker, open-minded, ready to take some risks, because we're talking about disruptive innovations too, that sometimes really you need to pick fights with certain segments of the market, or you need to pick fights with other authorities. But it really sets the tone for the whole organization, encouraging innovation too, and successful implementation of these changes with successful management of these changes. It really is important. This person is you can see the vision in this person. It champions the vision. It also encourages responsible experimentation throughout the organization. And a few examples here, and I'll go back to the first one later. So Ravi Menon, Roberto Campos in Brazil, Ravi Menon in Singapore. So a few examples that we found, and we developed this further in the publication. So what are the key features? We identified like 5 key features of this tone-setting leader. The first one, this person signals that innovation is central, not an isolated topic, like an isolated project for the organization. So this person also promotes the out-of-the-box thinking throughout the organization, not only like the people who are in functions that are the main goal, for example, supervisory, regulatory functions, but also people who are supporting those functions, such as IT and administration. this person really fosters a culture of innovation and agility to solve problems. So if there is a new type of regulation, let's say open finance, this person tries to find ways to break culture that has not been so successful in pushing for a new type of regulation, a new type of organizational culture. And this person also empowers the staff to be agents of that change. And I mentioned that. So this really goes down the different levels, and all the different staff in their different functions, they feel empowered to also align with that change. And last, it emphasizes that cross-departmental innovation that's really needed for many of these topics of innovation nowadays. Can you go to the next one, please? So the example of Ravi Menon in Singapore. So why did we pick Ravi as an example? He did a lot. So in the Monetary Authority of Singapore, during his mandate, he really set a clear pro-innovation tone at the top. He framed innovation as integral to MAS mandate and Singapore's competitiveness. So not only from the authority side, but also the relationship with the whole country. He championed many innovation initiatives like the MIS Innovation Office, the API Exchange, so many other innovation initiatives. It doesn't need to be a single one. He also legitimized internal experimentation and invested at the same time in internal capacity building. So it needs to be all these elements together, and he did that with MAS. He also encouraged an adaptive institutional mindset. So it's really this willingness and ability to innovate and sometimes take risks and sometimes fail. And he used this very visible leadership tone, which was also the case in Brazil too, with Roberto Campos. So let's see if I can move the slides here. No, I can't. Right. What are the challenges and key considerations for this tone at the top element that we identified? First, finding the right leader. It's sometimes not as easy as it seems. Sometimes the leader just shows up, but often this leader comes with a mindset that is trying to challenge the status quo. So it might be someone from outside, sometimes from the private sector. Many of the leaders that we found, they were from the private sector, but some of them were not. Empowering the leaders. So as I mentioned, some of these leaders were a little bit below in the hierarchical level. When they are not right at the top, they might need actually some extra power. So this leader needs to be empowered. And also, one of the things that are most critical, and it has to do with the next element, is ensuring the continuity when the leader actually goes, when the leader leaves the institution. How can the institution ensures that this openness to innovation and all the internal changes that the leader empowered and supported, they remain in the institution? Two last elements, challenges, balancing ambition with stability. Of course, so some people will accuse the leader that he's risking instability. He's actually not, or she is not protecting instability because this person is encouraging innovation. So there is always a trade-off, or at least apparent trade-off between the two objectives. And last but not least, matching this vision, the tone at the top, with the resources, which are lacking in many countries sometimes to implement the vision. So not only people, but also resources, internal resources. I'm trying to, okay, innovation culture, that's the third element, is very closely related to the tone at the top. As I mentioned, what does it mean? So in practice, it's really a set of values. It doesn't need to be written. It doesn't need to be implemented or implanted, but it's a set of values, attitudes, and behaviors that really encourage and support innovation, this type of innovation-prone, innovation-friendly environment inside the authority. It promotes experimentation, agility, and learning from the failures, just like I mentioned in the case of Singapore. And it really matters because it encourages this risk-taking at the institutional level without jeopardizing the core mandates of the authority. So it promotes this cross-department collaboration, really reducing the silos that many authorities have today. It supports the development of new skills and really tries to retain high-skill talent in the organization, even in the context where there are challenges with budget and other resources. It balances this traditional supervisory culture with a more modern technical capability. And one of the objectives is really improve the anticipation of emerging risks, not only after the risks are already identified, it's actually looking at the future to see emerging risks, trying to balance the risks and the opportunities of innovation. And lastly, it really strengthens the credibility with the market. So it strengthens the credibility that the market sees, that the market feels towards the regulator. Some examples here, it's internal learning events, such as innovation challenges, innovation squads, cross-representation of departments in these initiatives. Okay, example from Bank of Ghana. Sorry with the slides here. I think there is some delay. One example is the Bank of Ghana. It's quite well known, at least people from the region and other people have been studying innovation within authorities. So in the Bank of Ghana, they created this innovation office. This office was supposed to be quite limited in its role to deal with the new types of entities that had been regulated. It wasn't that they were not regulated by the Bank of Ghana before, but started to be regulated by the Bank of Ghana. But this small unit that started very small actually created this innovation culture within Bank of Ghana, which is contaminating the other departments of Bank of Ghana in a very good sense. So it was gradual development of an innovation culture within Bank of Ghana, and it really reflected in outcomes that, such as the shift away from a very, very bank-centered view of the market, but towards a more innovative view of the market, like a very broad sense of what the different actors in the market in Ghana can contribute to inclusive innovation. So this unit was established and then it really expanded to about 46 people today. The hiring strategy was very innovative too, such as like we want non-lateral thinkers from other departments. So they were also bringing people with innovative, open minds from the other departments of Bank of Ghana. They did these cross-departmental engagements too, such as the FinTech Fridays. They collaborated very closely with peers in other countries, in this case, very closely with the MAS in Singapore. They did also cross-functional project teams as really this mechanism of breaking silos. So I already mentioned breaking silos before, but this is very, very important to produce this innovation culture in very organic way. And very strong engagement with the fintech firms, which in the past were not even considered by the Bank of Ghana as a segment of the market which you should talk to. And broad internal support for innovation agenda. So there was very, very clear support for the head of this unit, the FinTech Innovation Office, by the senior management of Bank of Ghana. So this has created a very powerful change within Bank of Ghana. And now I'll pass to Mehmet to go to talk about industry engagement. Thank you, Mehmet.
Thanks, Denise. Hi, everyone. Let me try to change this slide. Okay, thanks, you were changing. So another key element is industry engagement in that we have found in our work, and basically this is about making sure there are both formal and informal channels, available for the regulator and the industry to have ongoing conversations, and to stay in touch. And also, importantly, this should not be something that happens once in a while or when regulators need some sort of input. But that dialogue should be, open, frequent, and a two-way dialogue. And also, regulators should ensure that the different stakeholders, different voices are represented in this industry engagement, including banks, fintechs, I don't know, other market players, market participants. So why does it actually matter? So basically, as you know, financial innovation is moving quickly. Technologies are evolving, business models. We have new business models. They are constantly changing, and most likely in 6 months there will be another business model. There will be another innovation, etc. So, and the authorities need to keep up, with that pace. And regular engagement creates somehow space for mutual learning. So what I mean is the authorities, the regulators have gained better insight into what's happening in the industry, in the market, and what are the risks that might be emerging in the first place. And at the same time, the providers, the players, the firms, fintechs can get a clearer understanding of regulatory and supervisory expectations. And so basically, it also helps to build a more transparent and predictable regulatory environment. And actually, this is very important for innovators who are often dealing with a lot of uncertainty in the market. So in the next slide, next slide, please.
I think you can do it, Mehmet. Try, please. It works.
Okay, just okay.
I had the
Okay.
confidence you can do it.
Yes. So, thank you. But simply having engagement channels is not enough, and the engagement needs to be structured effectively. So basically, here, let me highlight a few key aspects here. First, I can say the representation. So basically, it's important to that a wide range of stakeholders are included, and this shouldn't be just limited to large established institutions, large incumbents. So they also need to hear the authorities need to hear from, I don't know, smaller fintechs, other non-traditional players. And the other thing is having the right people involved. And engagement becomes much less effective if the participants don't have the authority to make decisions or move things forward. So basically, it's important to have that the right level of industry management is at the table. And the other one is the consistency. So basically, engagement shouldn't only happen at specific moments. Um, for example, when a new regulation is being drafted or during a crisis, etc. Innovation is basically is happening all the time. So communication should be ongoing, continuous, and routine. And the finally, industry participants, the players, shouldn't feel like they always have to wait, for regulators to contact them, to reach out to them, etc. So the industry players should feel empowered to start the conversation as well. And when done well, industry engagement brings several important benefits, as you know. So basically, as I mentioned, it will improve mutual understanding between the regulators and the industry. And also, it creates more transparent and more equitable access to regulators. And that's particularly important for smaller firms, smaller fintechs, who may not have the same networks or established relationships as larger institutions. But there are also challenges. For example, in many cases, regulators simply might have simply limited capacity and resources to engage frequently with the industry. So for providers, especially new entrants, a common challenge is not knowing which regulator to approach with their questions, with their, I don't know, applications, etc. And also in some cases, the firms themselves, may have limited capacity to engage with, authorities, regulators, particularly, especially if they are at the early stage or operating with, small teams. So different countries approach industry engagement in different ways, as you know. And one of the common approaches is to create innovation facilitators. For example, fintech offices, innovation hubs, sandboxes, regulatory guidance units, etc. So, and these create formal channels for firms to raise regulatory questions, and also it gives the regulators early visibility into the new technologies, new business models, etc. And one example we added here is from Ghana. So Bank of Ghana basically created a fintech and innovation office, and the office provides licensing information, yes, explains regulatory requirements to the industry, etc. But at the same time, it's also allows innovators to book virtual appointments, or to start parts of the licensing process online. So in our report, you can find other examples, and also in the other slide deck we will be sharing with you after the session. And another approach is working through industry associations, as you know. So basically, they can bring non-banks and fintech perspectives into regulatory discussions, especially this is important, especially in markets, traditionally dominated by the larger banks. And as I mentioned, smaller firms, smaller providers often don't have the, same resources or regulatory expertise. And in this case, especially associations can come into step into to collect feedback and represent these voices more effectively. So one example is actually from Malaysia. So regulatory sandbox applicants often come to the regulators at different stages of their readiness. So basically, to address this issue, FAOM, the FinTech Association of Malaysia, helps firms prepare, before they formally engage with the central bank, with the Bank Negara Malaysia. So basically creating a press sandbox pipeline. So Brazil's open finance framework is actually a good example of structured industry engagement. So the Central Bank of Brazil required both banks and non-bank associations, to participate in the governance structure. And in the industry participants, the players work together through, formal working groups. And also there were information channels to solve technical challenges, to solve operational challenges. But at the same time, the Central Bank of Brazil remained like the final backstop when industry couldn't reach a consensus. So basically, this created like faster implementation, stronger industry buy-in, etc. in the open finance ecosystem. So another key element is mandate, as Ivo mentioned at the beginning of the presentation. So basically, so as you know, mandate, determines an authorities, regulators, key policy objectives, tools, responsibilities, etc. And as you know from your experience, they often centered around financial stability, market conduct, financial market integrity, consumer protection, etc. And these mandates help regulators prioritize resources and manage trade-offs. So why does it matter for innovation? So often regulators feels constrained by their mandates. So if innovation, if competition, for example, is not explicitly mentioned as a policy goal mandate, they may hesitate to engage or take action in that space. But in many cases, the limitation is more perceived than real. So with the right interpretation of existing mandates, authorities, regulators actually can often do much more than they think. And this is the case, especially when the leadership connects innovation to broader goals like inclusion, efficiency, or competition. And we have seen different approaches globally. And so some countries have explicit fintech or innovation mandates. For example, India, South Africa, and Mexico. But others have indirect mandates linked to the market development. For example, Singapore Central Bank, Monetary Authority of Singapore, Bank of Thailand, and Securities Commission of Malaysia. And in some cases, regulators have expanded and how they interpret their existing mandates. For example, linking innovation to efficiency, innovation to financial inclusion, consumer outcomes, or financial system development. And again, one example is from the Central Bank of Brazil. So in their case, having the efficiency mandate was, sufficient to deal with innovation. So how much does mandate really matter? First, a lack of mandate can limit action. Okay, but it doesn't completely prevent the action of the authority. And many regulators actually found alternative ways to support innovation by leveraging their existing mandates. Yes, an explicit innovation mandate can help by sending, a clear signal to the market, but innovation needs to align with the core objectives, and it should support broader objectives like financial stability, inclusion, competition, and efficiency. But so how to establish sufficient mandate to pursue innovation? So first, sufficient discretion. So authorities do not always need an explicit innovation mandate. So as I mentioned, what they need is basically sufficient enough flexibility within their existing legal framework to support innovation related reforms in the market. The second one is the culture, and actually culture and leadership matter more than the wording. So even with broad legal authority, innovation may not happen if the leadership actually is risk averse, or if the innovation culture, institutional culture resists the change. So basically strong leadership, a clear vision, and internal culture change, can move innovation forward, even without, any specific language or something like that. And also building political backing is also important. So sometimes the authorities, the regulators need support from, the government, the legislators, or other stakeholders, to interpret their mandate in a more innovation-friendly way. So in the next slide, I'm trying to change it, but we have an example from Chile. So actually this is from Chile and how the mandate played a role. So basically in 2017, um, Chile merged its banking, securities, and insurance supervisors into a single authority, single regulator, the Financial Market Commission. So, and the legislators intentionally added market development to its mandate. So that was important because it gave the authority, the CMF, the regulator, broader authority beyond, traditional supervision. And the regulator later used that authority to help, to initiate the Chile's fintech law. And also today, fintech law explicitly connects the CMFS regulators' market development mandate to the goals like, competition, innovation, and financial inclusion. Thank you. Over to you, Ivo.
Thank you, Mehmet. I hope you can hear me. So, just to explain, we have this very interesting bottle over the mouse. I don't know why it's set up this way, and maybe there are smarter ways to do it. But it's not that Mehmet or Denise are incapable of commanding the technology. It's that they're fighting over my mouse, and I'm fighting over theirs, and that creates this very strange.
Exactly.
That creates this very strange dynamic. So we've got really good questions, and before going to conclusion, I would actually like to address those questions. And there's a common thread across those questions, and that is what we call politics of innovation. We could have actually called the report politics of innovation, but that would be maybe a little bit of departure from how we wanted to focus our work on financial sector regulators. But one key findings is that politics and politicians play a very significant role in what happens in the country and how innovation agenda is advanced in the specific jurisdiction and for the specific financial market. So it kind of touches upon the question that Philip mentioned or raised about the coordination across different agencies. It does touch upon the question that Patrick raised around the political disruptions and changes in leadership. And it does touch upon the questions that Babacar raised around what happens when there is a disruption maybe coming from outside to the market. So we did find that there is so much more that can be achieved if there is a political stability, obviously, but also if there is, in case of instability, there is this continuity provided by the vision. And I'll just give one example without naming the country. We would have country with a strong articulated vision of the future financial system that would then experience political disruptions, but that vision was so compelling that even the new political leadership, or maybe plural leaderships, would still use that vision, pivot the narrative around the vision to fit their own political agenda, but still pursuing the same objectives. And that's something that, it's very hard, obviously, to replicate or implement. It really has to do with the political system, culture, and so on. But this is to say that the burden is not entirely on the financial sector regulators, and in fact, very often the burden is on the political leadership. And there's another country or another example where the whole push for competition and innovation, in fact, came from the top political leadership, but was fully embraced by the financial sector regulator and made the financial sector regulator one of the key leaders in the world. So I want to address that we are aware that political disruptions exist, and it's very hard to come up with a blueprint on how to address them, but it's something that regulators should work with, especially at the sort of the top level, obviously, but also manager level. So to speak, managing up and leveraging the political leadership towards the objectives and vision for the financial system. To Philip's question about besides the politics of innovation response, to Philip's question about the collaboration across agencies, we did find also that besides what I've already mentioned, the tone is quite critical because the tone very often is not very conducive to collaboration. Whereas if the leader is really fully embracing the cross-agency collaboration, sometimes it's contagious. And the other leaders, and again, we have examples where it was the leaders at the top, of course, supported by their team and the whole institution, but the leaders at the top who found the same language and find the same objective, and that would really then spread across the organization. And so without memoranda of understanding or other formal structures, there would be collaboration, joint retreats, joint peer exchange and workshops, and building the connections at almost personal level between organizations, helping to advance. Again, it's very hard to replicate if you don't have that leadership. It's not that you just provide a set of recommendations that can be implemented in a tick box fashion, but it's possible, and it's possible despite of resources, which goes to the point that Patrick mentioned. We are very well aware that the countries that we have studied have very different levels of budgetary resources available to them, and yet what we found very inspiring is that despite the resources, the countries that we would call leaders are trying to do something. So not everybody can do everything, and not everybody can be, let's say, Singapore of their own region because of the resources limited. But we have found that there are countries that are small. Well, Singapore is small, but small in terms of resources, and they're still trying to do something within those resources. And most importantly, they are crafting their vision and their plan to achieve that vision, being aware of the limited resources they have. And I would say that a big part of my, not surprise, but learning as part of this project was how creative people get when they have limited resources, and how they start deploying very different strategies and tactics to achieve what they need, even if the resources are limited. It's not always a perfect answer to countries that have very, very key constraints, but partially at least it is an answer. And then to the question that was raised by Edwidge, which is very interesting point around artificial intelligence, and goes to the question of how flexible that vision must be if we live in the times where everything changes all the time, and groundbreaking innovation comes to the markets every second week or so, and we would argue that that vision needs to leave some space for flexibility. But to your point, Edwidge, I do believe that the starting point for regulators is to get familiar with artificial intelligence themselves. And that has multiple ways how this can happen. Obviously, ideally, they have access to the cutting edge tools, and they can play with them safely in their own environment, kind of test it, not only relying on trainings where somebody tells you this is what artificial intelligence is and this is what it can do, but really having that lived experience on a daily basis, seeing what agents can do, for example, helping you to make decisions on licensing, scanning through your rule book and giving you the right questions and the right areas of inquiries when you are licensing new provider. It's just one example of many that are possible. So having the practical experience. But I think the other important part is the industry engagement that we've mentioned. The industry engagement that cuts across stakeholders and types of industry players, which increasingly means also the outsourcing companies and providers of underlying technology, right? Regulators can have that leverage to bring together stakeholders for roundtables, workshops, informal consultations, and let them feature and demo what they can do for the regulator or for the financial sector. Again, there are examples where regulators are doing that, and it dramatically increases their learning curve if they can see that. And I would actually encourage private sector providers to be active and reach out to regulators and say, hey, you know, we're building this tool for KYC facilitation. Do you want to see how it works? Because there are providers coming to you that may be licensing now using this technology, or existing players who are already incorporating this technology into their systems. So maybe you want to actually see how that works, and we are happy to provide it. So being proactive in that sense is very useful. I will very briefly just sort of in a marketing fashion, I think, go over some of the concluding remarks or summary points that we have prepared that you can then go over at your own pace, because that slide deck and its expanded version will be available online for download. So we've spent quite some time, and by the way, thanks for those great questions. And if you have a follow-up or you want to kind of make a comment of disagreement or agreement, please put it in the chat. But we've spent this webinar talking about the concept of vision-guided regulation that's anchored in the vision and then stands on those 4 key elements of innovation culture, industry engagement, tone at the top, and mandate. And here are some practical takeaways for each of those elements. So vision is effectively a regulatory tool. It's not a wish list. It's not something that we just dream about, but it's meant to be a practical tool that guides regulatory decisions. It can be that it starts with one specific area where impact can be achieved in a relatively short period of time, but it expands over the time and grows. And we've seen that in cases of Brazil, for example, but also Bank of Ghana and others that are featured in our work, where it starts small but really expands over the time. Ownership is absolutely essential. There has to be somebody who owns that vision and is responsible for its delivery. And it's a dynamic journey that should allow for flexibility. It changes as the world evolves and there are new pieces of information that inform that vision. Vision can only work if there is a tone at the top. A strong leader, strong in terms of understanding the importance of the vision and having the capacity to secure stakeholder buy-in and manage the change, who have the courage to hire new talent, who leads by example and empowers the teams within the organization, the regulatory authority, to embrace innovation as part of their work. And that helps to build innovation culture, where experimentation and learning from failures is appreciated. Of course, in terms of, in case of regulators, it means, you know, a safeguarded and safe experimentation, but still some where incentives are provided to advance innovation culture and to experiment, to be open-minded. And an important element of this new regulatory architecture, where you have a strong focus on innovation, is industry engagement. Industry engagement that is transparent, it's fair, it creates a level playing field, and it's bi-directional, so that regulators learn as much as the industry does from those engagements and exchanges. Last but not least, of course, mandate. Mandate, as we see it, is enabler, not a constraint. Where there's a will and where there's a vision, things are possible legally within the existing mandates, and when they are not, with that political support, sometimes a change of the mandate is needed. But we generally found that the leaders in innovation usually don't see mandate as a constraint, but rather an enabler. And with that, I'd like to thank all of you for participating in this webinar, joining us today. Again, this is recorded, will be shared on our website with the extended version of the presentation. And I also, again, want to thank everyone who contributed to this work, and wish you a great day.
Thank you. Have a good day.
Thank you.